Hello everyone, and welcome to the Startup Investing 101 webinar that we're actually going to be hosting today in partnership with Minionville. So before I actually go ahead, and by the way, Minionville is a financial educational media source. Before I actually go ahead and start with the webinar today, I would like to go ahead and read an important disclosure, obviously, since we are operating in the securities industry. So bear with me here. Basically, the disclosure is as follows. RockThePost.com is a website operated by Rock the Post Corporation. Securities transactions requiring intermediaries are offered by WealthForge, LLC, registered broker-dealer, and member of FINRA. By accessing this site and any pages thereof, you agree to be bound by the terms of use and privacy policy. RockThePost.com is intended only for accredited investors, for persons residing in the U.S., and for persons residing abroad in jurisdictions where securities registrations exceptions may apply. Rock the Post Corporation does not make investment recommendations, and no communication through this website or in any other medium should be construed as such. Investment opportunities posted on this website are private placement of securities that are not publicly traded, are subject to holding period requirements, and are intended for investors who do not need a liquid investment. Private placements investments are not bank depositions, are not guaranteed by Rock the Post Corporation or WealthForge, and may lose value. Neither the Securities and Exchange Commission nor any federal or state securities commission or regulatory authority has recommended or approved any investment or the accuracy or completeness of any of the information or materials provided by or through the website. Investors must be able to afford the loss of their entire investment, and any financial projections or returns shown on the website are illustrative examples only, and there can be no assurance that any valuation provided are accurate or in agreement with market or industry valuations. Any investment information contained herein has been secured from sources that Rock the Post Corporation believes are reliable, but we may make no representations or guarantees as to the accuracy of such information and accept no liability therefore. Offers to sell or the solicitations of offers to buy any security can only be made through official offering documents that contain important information about risks, fees, and expenses. Investors should conduct their own due diligence, not rely on the financial assumptions or estimates displayed on their website, and are encouraged to consult with a financial advisor, consultant, and any other professional that can help you to understand and assess the risks associated with any investment opportunity. So now with that being said, obviously that's the important disclosure that we need to give here prior to actually going into the content. But now we're going into the juicy stuff, into the good stuff. So with that being said, about Rock the Post. So Rock the Post essentially is a startup investing marketplace where we connect early stage, let me see here, I'm actually mentioned that to put this full screen. Hold on 1 second. There we go. So Rock the Post essentially is a, 1 second here. So Rock the Post essentially, well, I'm actually not going to put it full screen. I'm sorry about that, just changed my mind. So Rock the Post essentially is a startup investing marketplace where we connect early stage startups with accredited investors. The type of startups that you would actually see on our site are seed investments, meaning that they are at the early stages of their life cycle, and as well, as you see here, in our case, we've actually been embraced by the media. We've been mentioned by Time as one of the best platforms in the world, also by Forbes as one of the best tools for entrepreneurs as well, and by Business Insider as one of the hottest startups in New York City, just to mention a few. But the most important, our mission and vision since the beginning, when we decided to actually start Rock the Post, the vision came actually back in October 2010 with me and my co-founder, Tanya. And the idea was really to democratize access not only to startups, to gain access to capital so that examples such as Pandora that was rejected over 300 times before securing the round of financing would be something that would never happen again. Also, we do help with the crowdsourcing component to make investors better informed decisions. And then as you see here, basically the startups are early stage startups. They are companies that have been sourced from high end or high quality incubators and accelerator programs in the US. And then as well, they are obviously vetted by different processes that we will actually explain more in detail as we continue to move forward with the webinar. But then as well, we make sure that there is a secure process and an efficient process to actually go ahead with the transactional side. So just to give you an idea of what type of deal flow or what type of companies you're going to be seeing on the site, for the most part, these early stage type of companies, those are companies that are either on the seed stage, as I was mentioning, 750K type of a round size that you're going to be looking at, where the investments or the investors are going to be anywhere from 5 to potentially 50. The average is 20. The average ticket size is 10,000. But then, as you see here on this slide, you would find that most of the companies that we actually have on the site are companies that have a tech component. Companies that are in the high growth stage and that are going to potentially provide an exit or a return to the investor in 5 years or so, at least. So as you see here, technology is 56% of the companies that you see on Rock the Post. Consumer is 23%. Another type of companies such as healthcare, energy, or for example, art would represent 21% of the actual deal flow. So I was mentioning before that some of the companies the origin is actually from top programs. As you see here, these are some examples. Some companies have founders that are graduating from Wharton, Harvard, Stanford, MIT, and then some accelerator programs such as Y Combinator and so forth. Just so you guys know, I'm not making the full screen so that I am able to keep track on the number of the slide, because otherwise, if I would make it full screen, that would not be the case. But anyways, as we continue, hold on one second. So let me just make the screen a little bit bigger so that you guys can see it. So let me see. All right. So anyways, so as you see there, moving to the next slide, actually, which is the most important one, which is the agenda. We're going to be covering the basics of startup investing. We're as well going to be covering the differentiator or the comparison between startup investing and other investment options, choosing a startup investment, what it takes to do so, and then as well the terminology and technical details that cover a little bit the ecosystem of startup investing. The other part that is going to be very important as well is what happens after you actually make that investment. Like what's the process, what type of interaction, engagement is going to happen, and so forth. And then at the end of today, we're going to leave a section that is going to be for questions and answers, where any of you are going to be able to ask any questions that you may have, and obviously I will be more than happy to answer them. In the event that we're not able to answer some of these questions, you will be able, one second here, to make sure that you guys are able to see it. Just zoom in. So probably you guys are able to see the slide a little bit better. Sorry about the technical issues, guys. Just making sure here with my team. They were on the background. But anyways, we're going to be reserving a little bit for Q&A. And as I was mentioning, if we are not covering that question that you may have, we would actually answer it via email, so no worries about it. So let's go ahead with the first part of the webinar today, and it's basically the basics of investing, of startup investing. So essentially, startup investing is when you invest in an early stage company, a company that it could be viewed as a garage stage, right? It's the possibility to really participate on the upside as opposed to really investing at the time or at the stage where the company is publicly traded, where the upside is lower, because with more risk there is more reward, as you can imagine, no? So some of the companies that were at an early stage or that were available for startup investing were, for example, Facebook, were, for example, Dropbox, Twitter, and so forth. So just to give you an idea here, let's do a little poll here. We're going to be pulling out a poll, and I want to ask all of you if you have ever invested in a startup. So if you don't mind, let's see if you can answer that for me. You would be able to get that little screen. All right. We see here all the people voting. Please keep voting. Please keep voting. All right. Let's close the poll now. So 43% say yes, that they have invested in a startup before. 27% said no, and 30% say no, but I would like to, which is fantastic. So who typically invests in startups, right? So the people that are, or the people that you would see, or the profiles that you will see created on our platform are actually angel investors, which is for the most part the biggest component. The other one is early stage venture capital firms. Those are VCs that have under management for the most part 50 million, between 50 to 100 million, but for the most part it's under 50 million. And then we have some family offices. As you see here on this slide, you will be able to find what this represents on the market. And actually the market is growing substantially. And as well, I would like to mention that the angel investors are people that typically can afford this loss or this investment, because it's, as you can imagine, a high risk investment. And then as well is someone that could potentially provide that additional value of having some expertise or not on the market, so that they can add some type of knowledge to the founder, to that startup that is at an early stage and needs all the advice that they can get. This could be either via an advisory role or as well via a directory role. As you can imagine, becoming a director and being in the decision making of the startup side, they are going to potentially require you to own or to invest a majority of that given round in which you're getting involved. But anyways, for example, an advisory role is something that could make sense not only for the startup to be updated on that expertise and that knowledge that you may contribute, but then as well for yourself to be more attached and more connected to how the company is doing, to that progress, and so forth. So, in addition to the benefits of this, I would like to again mention what are some of the benefits, of investing in startups. I would say that not only investing in startups gives you the opportunity to participate in these high-risk investments, but then as well to be part of the tomorrow, be part of the companies that are going to create that technology that is going to make a difference in people's lives and so forth. So in the end, for example, when you're investing in the public markets, it may or it may not, it's just an investment that you're placing, right? Obviously, it's more liquid and you can buy and sell that at any point. But the beauty of really investing in an early stage company like the ones that we have on the site is that you can become actively involved, right? You can provide that advice and so forth. So the next topic that we're going to be covering today on the agenda is the startup investing versus other options, because I'm sure that especially for the 30% of you that have never invested in a startup before, you're probably going to be thinking like, what is this going to represent? How is this going to be looking like in my portfolio? How is this compared to, for example, investing in the public markets or in other type of securities and so forth? So, with that being said, the first question here in this section is how the value. I would say that the hardest part of because when you're investing in the public market, you're able to track your value. I mean, how many of us have, for example, invested in a stock, in a publicly traded stock, and you're like refreshing the screen time after time to see how that stock is performing with respect to the 2 minutes before? Well, here is the good and bad news, right? When you're investing in an early stage company, in a startup company, in a privately owned or private company, private offering, the difference is that you're not able to really track that well how that investment may be performing. So there are different types of things that would actually happen that would increase the value since you initially invested. I think that as you see here, the earlier you're able to invest in the company, the cheaper is going to be the value of the company. But then as well, as I was mentioning earlier on the presentation, the higher the reward or the upside is going to be. So, for example, at the beginning, during the friends and the business angel, which is normally the early stage life cycle of the company, you're going to be looking at valuations right now. What we're seeing is anywhere from 2 to 4 million. And that's where you are essentially allowed or able or invited to potentially participate. As the company continues to add value, this could be like, for example, via user growth that they're getting, customers that they're closing, partnerships that they're closing, another round of financing. That's all type of events that are adding value to your investment. No? But in the end, what I wanted to say is that at the early stage, you're going to be invited to really invest in that company, but then later on, as the company continues to grow and to become more of a corporation, then the idea is that only a venture capital or other financial institutions are going to get involved. So basically what happens is that the minimum investment that is required to potentially participate on the company is going to increase, and for the most part, it's going to be outside of the scope of any angel investor. What we see for the most part as well is that when the company continues to grow and to pass on to later stages of the life cycle, what happens is that there is a venture capital firms that would come to do different rounds of funding and so forth, and business angels or super angels in this case are the ones that would be invited. These are people that would be putting tickets anywhere from 500,000 all the way up to 1.5, 2 million. So this is not the average angel investor. No? So with that being said, the types of liquidity events that would happen, or when you can actually take the money out, because this is a highly liquid investment, right? You're not going to be able to sell your shares or your ownership at any point, like it would happen on the publicly traded markets. But really, there is certain events that trigger that liquidity event, which is going to help you to get that money back. And that's going to happen with either having a qualifying round of financing, when that later investor is going to buy your shares back, when there are investors that are buying some shares of those other investors at any given point, and then as well when the startup gets acquired, when there is an acquisition, another company that comes along and wants to get that company. The other point, which is going to take a little bit more time to actually develop, is the actual IPO, when the company goes public. I will describe that a little bit more in detail in a little bit, but that's a little bit longer of an event. That's anywhere for the most part between 5 to 8 years. So we're talking about the investments that first you should or you could afford to lose, and then as well investments that you are comfortable leaving them for the long term. What we've been seeing actually is that, especially from our conversations with family offices and wealth management divisions and so forth, is that startup investing normally would represent anywhere from 5 to 11% of your portfolio. If you're going to be combining that and adding that to other type of investments that you are potentially doing. In any case, I think that as most of you know, at least all of you that have invested in companies before, which is 43% of the people attending today, you would know that every company is a different story. So the scenario is obviously going to be changing and varying at the same time. So moving to the next slides, here the next slide, you would see that how long it would take. This is a very big question, very good question. How long it would take to actually you getting your money back? As I was mentioning, this is going to be anywhere from 5 to 8 years. Just to give you an example, Facebook, it was actually incorporated in 2004. People started investing and so forth, and then it was not until 2012 when it did the actual IPO. So during that process, there were certain liquidity events that probably happened, which are the ones that I was mentioning, like people buying out other investors on other rounds of funding and so forth. but on that IPO really took all that amount of time, no? So obviously, I was mentioning that startup investments are highly liquid. I would again suggest not putting more than 5 or 11%. Obviously, I'm not in a position to give any advice here, and I'm not making any advice. But if it was my own portfolio or what other wealth management divisions have told me, I wouldn't put more than something that I could afford to lose. No. So the type of return that you're going to be expecting, which is the magical question, right? It's the $1 million question that everyone always would ask themselves, like when they review investments, like how much money may or may I not take out of this investment opportunity, no? So you need to understand first of all that you may lose all your money on a startup investment opportunity because there's a lot of risk involved, and you need to take that into consideration. So as I will continue to explain, as we continue to move along on the presentation, you need to make sure that you are diversifying enough to get some good ROI from the investments that you're losing and getting from the investments that you're actually making good returns, so that you get a positive return and you cover as well the losses. But in any case, I would like to explain or to give you guys the rule of thumb that people would normally do, and this is called the 1/3 rule of thumb. And with this 1/3, what I mean is that out of the investments that you would make, normally I would suggest, or what I've seen from angel investors is that for whatever amount of money that they have, they will be making anywhere from like 8 to 10 actual investments from that amount that they're able to allocate to startups, so that they're able to diversify. But in the end, the rule of thumb means that 1/3 of your companies are going to go out of business, 1/3 of your companies are actually going to break even, and 1/3 of your companies are going to give you enough returns that are not only going to cover for the losses, but they as well give you good returns to give some positiveness to that portfolio. No? So the next slide is very important. How can I minimize my risk? No, I've been mentioning all the time that these type of investments are highly liquid. It's not something that you can buy and sell right off the bat. It's something for the long term. So the important question here is, how do you diversify or minimize that risk that you are actually taking by making an investment into one of these early stage companies? So I would say here that there are some different ingredients that you need to consider when you're making that investment to minimize the risk. The first one is that you are allocating a small portion of your portfolio to this type of investments. That's the first one that I would do. And then the other one is the diversification. No? At the end of the day, one of the coolest things about what we're doing at Rock the Post is that instead of like what happens in Silicon Valley, where they are going to require you to make $100,000 minimum of an investment to participate in a round, this is what used to happen some years ago. So if you were not Ron Conway or Reid Hoffman from LinkedIn, it would be very hard to get into good deals. So they would require maybe anywhere from 50 to all the way up to 150,000 to be able to participate in those rounds. So the beautiful thing about what we're doing, and this is part of the vision and the mission that we have, is democratizing the process, right? So now instead of putting 150K into one startup, now you're able to put 100 or 150K into 100 or 150 different startups. So the beautiful thing about that is that you're able to diversify. The reality is that 1 out of 10 startups is going to be successful, and the other 9 are not going to be that successful. So this opportunity of diversification helps you to really find the good deals that are going to help that portfolio thrive. So the other part here that I would suggest is that you create an investment thesis. So when you are investing in startup companies, you need to invest in stuff that you either have an expertise or that you have also some sort of knowledge or belief. So let's say if you're a big fan of, in this case, let's say the sharing economy, right? So in this case, you will be investing in all types of companies that are similar to, for example, Lyft, Uber, for example, as well Airbnb, and so forth. So you would be specifically investing in those companies that fit your investment criteria. One of the cool things that we have at Rock the Post actually is that you can create your own investment thesis, and you would actually be matched and so forth, depending on the scenario with certain companies. No, we are actually creating a marketplace as opposed to an open listing, which is the big differentiator between us and others. No, but the other thing that I would probably suggest for all of you guys to minimize the risk is that you invest with people that you know, with friends. Let's say you create like a little group of like 2 or 3 friends that you're going to be investing with, and that they may or may have something different to contribute to the table, so that that decision that you guys make becomes even more powerful. Something something that we really believe in is in the crowdsourcing of the due diligence process. So on the site, actually, you're able to see other people's rating and feedback and so forth as to what they think of the company. No? One of I don't know, I mean, how many of you are accredited investors here, and we will jump onto that definition later. But for those that are accredited investors, we actually do this thing called the digital demo day, in which we have companies pitching their own business to a live audience, and during the digital demo day, we let investors rate the companies on the market, on the team, on the deal, and so forth. And for example, last month we had over like 20 or 30 venture capital firms, and as well angel groups attending, representatives from angel groups. So that gave the investors the opportunity to actually see at the end on the overall score what people were thinking about that. And that's the beautiful thing about the crowdsourcing process. So with that being said, moving on to the next slide, let's see what we have here. Oh, and before I jump to the next slide, the way in which you can invest in a startup is going to be either by a convertible note or via an equity round. I will get into detail as to what are the differentiators between one another in a little bit, but I just wanted to put it in your radar for now. So just give me a couple more slides, and I promise that we will jump into this. So, as you see here on the next part of the presentation, let me just catch my breath here, folks, drinking a little bit of water. So, how to choose a startup investment, right? I think that this is a very important question that I assume many of you make when you're reviewing deals, when you're going through certain deal flow that you've received either by other friends or that you've seen on our site, or any leads that you, for example, receive. No? So in this aspect, the initial tip that I would, for example, give you is that you conduct your own due diligence, right? So that's critical. So due diligence, I mean that you're going to be doing research on the team, on the company, and so forth. And then as well that the most important, that you're very respectful to the founder, no? Because these guys are basically early stage companies. Their biggest resource is their time. So you don't want to be, like fooling with them around and messing with them around, going back and forth with the questions if you're not sure, because otherwise the word is going to spread around, and the most important thing that you have is your credibility and the name that you're creating for yourself. So startup ecosystem is small, so just so you know, just be mindful and respectful and at all times polite. So the next part is how would you perform a detailed due diligence? Sorry, I kind of like jump slides there. The way to perform a good due diligence process is by reviewing very well the legal terms of the private offering, of how that startup is intending to actually sell equity or sell promissory notes via convertible notes of the company. But the way to do this is by analyzing the competitive landscape, see who else is out there doing the same thing that they're doing. Also, you can, for example, dive into the business model, try to see if the revenue streams make sense, if that company down the line is going to be able to, for example, monetize well and scale by itself, as opposed to intaking investment round after round. You definitely don't want that. And I would say that in this regard, the investor trends, and we have a very cool investor trends report on the site that we actually published, they actually tell us, and what we've been seeing in the market is that what you saw in 2005 of like people very much concerned about the number of user registrations, the user growth, and so forth, that's important. But right now, what really counts is how you're making your first dollar. So that's what investors are going after now. So yeah, keep that in mind. So some of the questions that you may ask the founder when you're conducting the due diligence process is to ask about the team members, to ask about the background of the founders, to ask about which competitors are out there, what's the advantage that they have towards their competitors. Try to ask them who are the potential acquirers, right? Because as I was mentioning before, the way you're going to be getting your money back and getting that ROI is via, for example, an acquisition. So try to see who are going to be the best institutions, better suited to actually go ahead and give that check that's going to give us money not only to the founders, but then also to the investors, no? So with that being said, if you are, for example, first to investing in startups, then I would suggest that you take a little bit into account, for example, reviewing who is investing in the company, what are the people that are behind the advisors and so forth. So yeah, so you become a little bit more comfortable with the process, especially when you are a newbie at the investing in startups, which we have around 30% of the people here attending today. You want to make sure that there is certain components or certain pieces of traction that is telling you that company is already getting some momentum. So some of these aspects could be like who else is investing alongside the company. This could be, for example, if the company is doing an equity round, what are the venture capital firms that are behind. As you saw on one of my earlier slides, you would see that we have some of the top venture capital firms actually establishing a valuation on these companies and later, you know, opening the round to other investors like yourselves to fill in the offering. But really, there is certain things that you could do to actually get to a comfort zone, right? With pulling the trigger and making that investment. So some of this other stuff that you could do is we have on the blog different sections, for example, of Meet the Startup, where we are going more into the human side, into the human component of the investment, and getting you to get to see who are the people behind the company. You know? The other stuff is the digital demo day, as I was mentioning earlier, where you're going to get to see the founders pitching real time their business, where you get to see them defend themselves with Q&A sections and so forth, where the investors ask some really good questions and challenge them right there in the spot. But then I would say that I would like to welcome you all to think that this is startup investing, right? I like to call this as people investing. In the end, there is many things that happen to a startup. The business model can change overnight. There is tough times for a startup that are going to be presenting and challenging the company at all times, but top people will stay there forever. So whenever you're making that investment, not only base your investment out of trust, in addition to the ROI, out of trust that you, for example, have built during the due diligence process with the founder of that company, but then as well, you know, keep the ROI in mind, no? But again, there is you know, like the biggest scareness or the biggest component that will scare people out is losing obviously your investment, no? Like putting the money into one of these companies and the investment having to shut down their doors. Keep in mind that the founders and startups don't run out of money and close their business because, you know, they don't have more capital in the bank. They close their business because the founders run out of energy. So make sure that whenever you're making that investment, you're pulling the trigger, you're investing in that individual behind it, that individual that is going to be able to face certain challenging times. Because when you're building a company, startups in the end, startups hurt. They hurt to be built and so forth. So keep that in mind. So anyways, with that being said, I would like to move to the next slide here and how to judge the accuracy of the valuation. I'm going to slow down a little bit here, folks, because I know that the Spanish accent may be kicking in. So I want to make sure that you're not only able to understand this Spanish accent of mine with English, but then as well to keep track of how we're doing here with the webinar, no? And with the slides. So the next slide, as I was saying, is how to judge the accuracy of the valuations. No? So the valuation is really a give and take game. No? And this is one of the parts where we actually protect the investor, no? Because the founder is always going to want to shoot for the moon, right? They are always going to want the best valuation possible for them and so forth. And that's why there is two different types of securities that we offer. We offer the convertible note that I would explain in a little bit right after we pass from this slide, and then you have the equity. So if you don't have a well-respected VC or a well-respected angel group, then we're going to direct you to the convertible note route, where there is no valuation established on the company, and it will be later on established by a venture capital firm or financial institution that would be investing. No? But going back to this scoreboard, no? Once that you're thinking about what's the valuation process and so forth, there is the scoreboard method that was actually designed by Bill Payne, and this scoreboard basically what it gets is a target that is specific on a region and a vertical, and it basically creates it has different characteristics that come actually into place to determine the valuation of that company. You know? The valuation in the end is an art. Establishing the valuation is an art, and that's why I think that if you are a newbie, and this is going to be one of the first investments that you're going to be doing, make sure that you're investing alongside other well-respected investors, or you are investing via the convertible note where there is no valuation actually being established on the company. So let's jump now into explaining the difference between the convertible note and the actual equity round. I think this is very, very important for you to understand, folks. So the convertible note is basically a legal instrument in which it's cheaper. It's obviously cheaper than an equity round. Normally, convertible notes range as a price from a legal perspective around $5,000 or so, $5,000. And the equity round is going to be a little bit more expensive because there is more negotiation involved and so forth. The beautiful thing about the convertible note is not that it's only cheaper for the startup, but then also it's easier and quicker to actually close for that company and also for the investors. No? So on the convertible note, there is certain things that you really need to keep in mind before pulling the trigger. So this is the interest first that you're getting on your investment. Then there is the discount that you are receiving on the next round of financing, and then the cap that is going to establish on the valuation. So what I mean with this is the interest is going to be established on the amount of money that you're putting into the company. That is going to be accrued for the most part on a yearly basis. You are normally establishing a time frame until there's a maturity date where that debt strikes or that it's actually repaid of around 2 years or so. But then there's also the discount rate that comes into the equation. So the discount, what it is that right now what we see market is 20%, but that 20% is applied on the valuation on the next round, right? Because this convertible note, remember, there's no valuation established. It's pure debt where the company is selling. And what happens is that when you're putting your investment and there's that discount rate, you're waiting basically for another financial institution to come in and make an investment and set a valuation. So once that valuation is set, in let's say 1 or 2 years later, then you're going to be coming in and converting into equity, that debt into equity with that percentage of interest, which what we're seeing in the market right now is 8%. Also that discount, which is 20% right now what we're seeing in the market, and that's applied basically on the conversion. So let's say if 1 or 2 years down the line, a venture capital firm comes in and they say, okay, sir, your company is valued at $90 million. If you have a cap, which is basically putting the ceiling on that valuation that is established on the note during the time where you agree to make an investment, let's say of $5 million, if the valuation set by the venture capital is $9 million, what happens is that a 20% discount is going to be applied on that $5 million, which is going to be $4 million. And then if you're investing, let's say to put an example, $10,000, then there's going to be an 8% that is applied on that 10,000. So what happens is that the math, if you do the math, you're basically coming in with not $10,000, the $10,000 and $800 that you've accrued as interest from that time that you've had the investment, but then as well the 20% that I discussed earlier. So it's $10,000 and $800 at a $4 million valuation as opposed to the $9 million valuation. So when you're investing in a startup that is via convertible note, these promissory note terms, make sure that you feel first comfortable with the interest. Second, that there's a discount rate applied on the next round of financing that is market. what the market is actually paying at that point. And then as well that there is a cap, because if you don't have a cap, let's say the company does like an amazing job and goes like to like a $30 million valuation, you did invest and you did get more risk than the actual investors that are coming later. So that cap, let's say if it was on this example of the $5 million cap, you would always be coming in with that $5 million with a 20% discount, which is the $4 million on the valuation, converting then, you know, like with the other people that are coming in at the $30 million valuation. No? So I know that this might be a little bit complicated, but if you go into our blog, there is some good entries that we've actually drafted ourselves to try to educate a little bit our community, right? Because for us, education is critical. The other scenario, which is very much straightforward, is the equity rounds. So the equity round basically happens when there is a valuation established on that entity, you know, on that startup. So basically they would come, they would say the value is X, and then that value would actually determine with the total amount of shares issued by the company, the actual price per share in which you're going to be getting your stock. So the idea here is that you're always going to be increasing the value of the company. So meaning if you come in at whatever valuation and whatever price per share, there is going to be different rounds of financing, and each round of financing is going to go higher and higher, not only on value, but also on your price per share. So I think that that's the reason, the main reason why it's important that you're investing in a priced round where there is well-respected investors, venture capital firms, angel groups, and angel investors that have done this before, so that they get a good idea of what value or what, you know, good fair terms were actually in between the investor and the entrepreneur when putting a valuation of the company. Because the last thing that you want is when you're, for example, investing, let's say, you know, like we wouldn't have this safeguard, no, of having a well-respected VC or an angel investor or so forth establishing the value. If we would let the entrepreneur, they could, you know, for example, put a valuation of 10 million, then there is a venture capital firm that would come later at the next round of financing, let's say at the Series A round, and they will say, no, sir, your company is not valued at 10, your company is valued at $5 million. So that actually is going to cut in half the early stage investors that believed in the company early on, and it's going to be a total disaster. This is what they call the down rounds. So I would highly suggest to make sure that whenever you're going forward with making an investment, you feel comfortable, you know who is investing, and if there's not a well-respected institution, just go ahead and move along to the convertible notes. So with that being said, we're going to pass here to the next slide. And basically, it's a. Oh, we actually went through this one. So yeah. So moving to the next one. So what's the terminology, no, and technical details? I assume that there is a lot of technical details here that probably may overwhelm you, no, because the startup ecosystem is a little bit different than what we are used to in the public markets and so forth. But it's important that we understand basically what each terminology means, no? So the first part of this process, which is very important, especially today, is if you qualify or not to be an accredited investor. This is something that I actually explained before. So if you're an accredited investor, let me see here. We're going to launch a little poll here, guys, to keep you engaged. So the question is, do you think you are accredited? So let's launch poll. Now please answer. Let's see what you guys think. All right. Almost there, almost there. We're getting a lot of votes. And let's see if I get the go-ahead here from my colleague. All right, wonderful. So as you see, we have 51% that think they are, 30% no. Anyways, you guys will be allowed to invest under the Title III of the Jobs Act once it's implemented. I'll get into detail with that a little bit later. And then the 19% they think that they're not sure about what this means. So just so you guys know, basically being an accredited investor according to the SEC, it means that you're making $200,000 in income for the past 2 years, or that you have $1 million in assets. As well, you can combine this with your spouse. This is $300,000. And in the event you are investing on behalf of an investment vehicle, a fund, or so forth, that would actually mean that you need $5 million right there to actually qualify. No? So before I jump to the next part, I didn't know if I was going to be actually mentioning this or not, but I think it's important. And for non-accredited investors, for all of you that don't qualify or don't think that you qualify to make an investment today as an accredited investor, what's going to happen is that with the Jobs Act, with the Title III of the Jobs Act, not only accredited investors like they have been doing for the past 80 years are going to be allowed to invest, but also for non-accredited investors, which are the people that have less than the $200,000 and all this stuff that you're seeing in this slide, also are going to be able to invest. What we feel that this is going to be implemented hopefully by the end of this year. That's where our expectations are at right now, potentially October. But there's going to be some safeguards, meaning that if you're not qualifying as an accredited investor and you are not an accredited investor, that means that if you're making over 100,000 but not yet getting to the 200,000, as a non-accredited investor, you're only able to invest 10% of your income. And then as well, if you're making under 100,000, you have the safeguard that's established by law that you're only allowed to invest up to 5%. So this really provides some safety and some safeguards for the investors so that they don't lose all their money. No? So what is the process of investing on Rock the Post? And this could be, the non-accredited stuff. It could happen anywhere from October to January. But we have our fingers crossed. This is what we've been pushing since the beginning. This was part of the vision and mission that we had when we created the company in 2010. And we're really trying to bring Wall Street to Main Street. So for us, it's very important that we democratize the process, not only for the investors, but then also for the startups as we're doing today. So on the next slide here that we're going to go into is the steps, like how it happens, the process of investing into a company on the side. So basically what happens is, first, you're going to have to self-accredit yourself as an investor. That's number one. Then you're going to browse through the startups, you're going to do your due diligence like we were mentioning before, and then you're going to pick what you think are the winners or the winner to actually go ahead with your investment. So what happens is that when you see that company, you've reviewed the terms, you reviewed the legal offerings, and after the due diligence and so forth, and you say to yourself, okay, this is a company that I would be excited about being an investor. So what happens is that you're going to go into the profile of the company, you're going to click on the apply to become an investor or invest, and then what happens is that we would receive the notification on our end, and we will have a representative of the company that is going to get in touch with you to walk you through the entire process and to make sure that you feel comfortable at all times. No? So the documents that are required for the eligibility, actually for you to become an investor into any of the companies that we have on the site, is going to vary. It's going to vary depending on whether the company is generally soliciting, which means that they are openly fundraising, advertising the fact that they are raising money, or this is obviously the Regulation D, Rule 506D, and then we have the Regulation, B, and then the Rule 506C, which is for the general solicitation. That's for the companies that are advertising the fact that they're raising money. For the other process, which is more private, there is a little bit less of a hassle or of a pain to actually make the transaction. But just to put into perspective, the documents that are going to be required for going forward with the investment, in the event that the company is privately fundraising or that it is not generally soliciting, the fact that they're raising funds and so forth is via the self-accreditation process, which is a questionnaire that you are prompted into at the beginning when you're registering on the site, the W-9, the identity verification that actually happens on the site, and then the electronic affidavits. So the other part of the process of actually moving forward to qualify is if the company is generally soliciting or publicly saying the fact that they're raising funds. The only thing that changes here is that we would need documents that would approve that you are, in essence, an accredited investor. This is via the tax income statements, a letter from the lawyer, a letter from the accountant, and so forth. Sorry, the accent again kicks in of the Spanish hero of mine. But then for the U.S. investors, it varies as well. There's going to be an international background check that is going to happen. So The next part of the agenda is what happens once you make an investment into any of the companies that we have listed on the site. And basically, as we see here, let me see here. What we have is there is two things that happen, right? You become officially an investor. You can be then an active investor, or you can be a passive investor. The difference between being an active and a passive investor is that as an active investor, you're going to become more involved with the company, because from my perspective, and I think any entrepreneur's perspective out there, it's really a partnership. It's like a marriage, right? The investor and then also the entrepreneur. So not only you need to be very careful with who you're getting into bed with, but then as well, I think that there is some standards or certain agreement that need to happen between both parties, right? So if you have expertise or know-how and so forth of the company, maybe it makes sense for you to try to add value. This could be by making introductions to other investors, to making introductions to partnerships that may add value to the company. And then, as well as I was mentioning again, set expectations, because I think that there is nothing more annoying, and I'm talking from a founder or entrepreneur perspective, than to be receiving requests on a daily basis from someone that has invested in your company. As an investor, you need to understand that the biggest value that you're going to be receiving is from the entrepreneur being actual focused on getting stuff done and trying to accomplish those milestones. So try to give them some room. Set some expectations from a perspective on when you're going to be receiving updates, when the company is going to keep you posted on certain events that are happening with the company and so forth. The quarterly reports, for example, on how the company is performing and so forth. And let's see here. Also, as I was mentioning, and I think that I've said this a bunch of times today, I'm really a big fan of the fact that startup investing is all based out of trust in addition to the ROI. You need to build that relationship and that trust with the entrepreneur, because there's certain things that are going to happen in the future, and there's not a worse thing than to not having that trust and then to have like more additional legal work to happen and so forth, because there could be many things that like could happen along the way, like acquisitions, mergers, potential exits for the investor and so forth. So it's important that the investor and then also the startup are both aligned since the very first beginning, no? As well, again, I would like to reiterate on the expectations, the communication and so forth. Be respectful of everyone's time. And now that we're finished with this, I am going to just walk you here through certain success stories that we've had last month, which I'm very proud of. We have here Pristine, which closed a $750,000 round on the platform with our help. We had as well, these guys are actually developing an application for Google Glass that is going to help when developing surgeries and so forth in hospitals. And then here, so that you see that we have a big diversification of deal flow, you would see SumXR was also funded last month. These guys raised a total of 1.3 million, and we are very proud that we were actually able to help these guys to raise the money. And for us, again, is the difference that we're making in people's lives, in this entrepreneur's lives, and that's what keeps us up at night, not only up at night, but also waking up every morning with a smile on our face, because we know that we're going to make a big difference from someone else's professional career life and so forth. So one of the case studies here that we have that had a very similar vision and mission to the one in Rock the Post, which is helping out entrepreneurs out there by matchmaking them and so forth, is Co-Founders Lab. These guys were actually one of the first companies to open fundraise and to publicly use that new regulation, which is the Jobs Act, and they raised with our help $680,000. So I'm very, very sad to say this, but it seems like we're coming now to our end. We're coming to, well, not to the end yet. We're actually coming to the questions and answers time. So we are, let's see here if we are able to address some of these questions. Remember, send any question that you have. You will be able to do so here on the chat that you have right here underneath. Put whatever question that you have, we will try to address it now. And then if that's not the case, we would be emailing you the answer. So, Tim is asking, how does passion reduce risk? So Tim, to that question, I would say that passion is extremely important. When you are an entrepreneur, you really need to be motivated by the problem that you are resolving, not only for really getting through the different life cycles, but also for attracting talent, because at the end of the day, what really matters is the team that is behind the idea. At least 100 other ideas are like buses. They come and go all the time. But the most important thing is the execution, because at least 100 other people have thought about that same idea or that same concept. So you need to make sure that you're having the right people that are going to be able to make the right execution and take the right decisions to actually get the company through different life cycles and to give you that good ROI that you're looking for. No? So the next question is from David. Should we invest between 5,000 to 10,000 to start? So again, the minimums are actually established by the entrepreneur. You're going to be able to see this on any of their profiles. So this is going to be, it could range anywhere from 1,000, 2,000, 5,000, 10,000. There are some companies that are a little bit more on the high end, some on the lower end, but that minimum is established by the entrepreneur. So as I was mentioning, if you have a certain amount of money allocated for making startup investments, make sure that you're able to diversify, meaning that if you have a certain amount of money, try to diversify in, let's say, like 10 companies and so forth, and then with that, you know, just try to see how much money that is going to entail now. So here the next question is from, let's see here, 1 second. Well, the next question is if we are recording the webinar. So we're actually not let me see here. Oh, 1 second. It seems like we get one question. Sorry, guys. I just have one of my colleagues that is throwing papers with questions at my face. Oh, here we go. The next question is from Juan. When investing through convertible notes, what happens when maturity date comes and no round has occurred? Or round has happened. So I think that question is a really good one. So I would say that that's why it's important that the interest between the investor and also the startup is aligned. What happens when the maturity date or the strike date of that convertible note hits is that the company needs to repay back that money that they've received from the convertible note holders. So if the company has not been able to secure a round of financing for, you know, whatever cost it could be, and that note has not been converted into equity, what happens is that the company needs to repay you back. And obviously, maybe the company has no money in the bank, so then that's going to mean that the company is going to go out of business. As you can imagine, that's not the ideal outcome that you would want for your investment. So what normally typically happens in this case is that there is a negotiation process where that convertible note may or may not be amended for a striking date that actually happens later down the line. No? So that's typically what happens when the convertible note doesn't happen. So explaining the pre-money valuation. This question comes actually from Maverick. So Maverick, basically the pre-money valuation means, and this is what happens on equity rounds, right? This is not on convertible notes. There is a price that is established on the company, and that means that there is a pre-money valuation. The pre-money valuation is the valuation of the company before the investment hits the bank account. That pre-money is established again between the investor and the entrepreneur, and then what happens is that once the money hits the bank, then the post-money valuation happens. So I would say that for this part, it's interesting maybe for you to try to understand how the money or the intake of that money is going to be affecting the overall pie of the company, meaning the cap table, who owns what of the company. But really the difference between pre-money and post-money is the valuation of the company before the money hits the bank, and the post-money is once the money is in the bank. So the typical valuations that you're going to be seeing when you're going to be making an investment in a price round is all pre-money valuations. Let's see the next question. Let's see. Okay, so the next question comes from Dennis. And he's asking, and again, the questions, you can have them here on the chat, put them in, and we'll try to answer as many as we can today. If that's not the case, we will answer them via email. So the next question from Dennis is, how much do I know of the percentage that I would be receiving as a result of an investment in a startup? So the percentage of equity that you're going to be receiving is going to be determined only if you are investing in a price round, so there's not going to be like percentages or so forth with convertible notes, because you're just going to be getting a promissory note that is promising you to convert that debt into equity later on for that percentage. But in the price rounds, the percentage that you're going to be receiving, again, this is something that you should ask from the founder, cap tables. I'm sure that if there is the proper material signed and so forth, they might share this with you. But really, the price that you're going to be getting from the company is determined by the amount of shares that are outstanding and issued by that company, and then as well by the valuation that has been established. No? So make sure that you're able to review all this financial information. So let's see. Okay, so what documentation will I receive after I make the investment in a startup? So the documents that you're going to be receiving are going to vary. So there is two types of documents that you will receive after you make that investment, depending if it's a convertible note round or a price round. If it's a convertible note round, essentially you're going to be getting a piece of paper, a promissory note, that is going to make official the fact that you invested whatever amount with whatever interest, whatever discount, and so forth, and with whatever valuation cap. But the document that you're going to be receiving in the event is a price round is essentially a stock certificate, right? That stock certificate is going to make official the amount of shares that you actually own of the business that you have invested. Let's see here. Let's see, because we're receiving a lot of questions. Okay, so the next question is, how long will you follow the company that is fundraising after fulfilling their need? And this comes from Chandra Segarra. And the answer to this is all right, so basically there is two ways to answer this, right? So one, you're going to be following the company all the time. Once you make the investment, obviously, you need to set that expectation with the founder regarding the reporting that is going to happen, that you're going to be kept up to date and so forth. But I think that it's very important here that early stage investing is people investing, right? So what I always say is that this is connecting dots, right? It's connecting the story of that company, and you need to verify that that team has been able to execute on whatever they promised. And once that's the case, then you would probably have that assurance that that team is actually executing the way they should. So I would say that it depends on the picture, it depends on the story, on the scenario, but there are some investors that would follow a company 3 months, other ones that would follow the company 6 months, and then other people that just follow the company weeks, no? Because on the due diligence process that I was mentioning before, let's say if they have like an incredible investor, or if they have a lot of momentum on the press, or a very good team, then I think that you get that assurance and the risk factor somehow decrease. So it should give you more confidence to actually pull the trigger. And that, let's see here. Okay, so the next question comes from Dusty, and his question is, how about a secondary trading platform? Facebook used a couple, as I understand it. So that's a very good question. I think that in the end, there's going to be certain agreements or certain clauses that are going to forbid you from actually reselling that stock from that early stage company. The type of stock that you see on secondary markets, in this case Facebook, was pre-IPO or a little bit right before the IPO. So we're talking about companies that have gone through different rounds of financing. There's actually happened some exchanges of stock and participation between different stockholders, and it's a different scenario, right? I mean, those are companies that have received an investment anywhere from 50 to 100 million and up. The type of companies that we have right now raising money on the Rock the Post platform are companies that have an average round size of 750,000. So the case is completely different. So again, I would say that whenever you're investing in a company that is at a seed stage level or a Series A level, which is that early stage financing, you need to understand that you're going to be in it for at least anywhere from 5 to 8 years. So don't invest. If you're looking to make an investment in a startup company, don't go to try to resell in months or in a short period of time, because it's really not going to happen, because the liquidity events are what are going to really trigger these opportunities to get the money back. You know? Let's see here. The next question. What are the indicators that the startup is likely to be funded in future rounds? And this question comes from Deep. So this is a very good question, right? So this is kind of like predicting the future. So I think that there is certain indicators that are going to help you that they understand whether that company is going to be able to secure rounds, because we can't forget that we're talking about technology companies. So for the first couple of years, they're going to be very capital intensive until they're able to break even and until they're able to have that product market fit that is going to determine that that company is able to scale by itself. So back to this question, some of the indicators are, again, is the execution, right? So you need to understand whether, one, that market is something that has been untapped, or that there is not that many competitors, or that there is a good team of advisors behind, or that the valuation was established by a good venture capital firm. Because the last thing you want, I would say, is investing in a company, let's say, just putting out there an example that has a price round, and it has, let's say in this case, a micro VC or something of that nature, that they tend to do more the spray and pray model, which is like investing in different type of companies. If they don't invest in the next round of financing, let's say in the Series A or the Series B, that's going to be a red flag for future potential investors. So I would make sure that you know who else is investing, because, you know, worst case scenario, they can always reinvest to give additional runway to the company so that they can fulfill the milestones that they will need for the next round of financing. But those, for the most part, are indicators. Well, I think that getting a lot of press is always a very good thing as a tech company. Seeing them on some of the major blogs and, you know, like getting some momentum in that aspect. But then as well, again, you know, like getting some good team members and getting advisors and so forth are definitely things that are going to be indicators that that company is surrounded by the best individuals that are going to help make it happen. Because relationships, in the end of the day, is everything, and is what really matters in the startup field, no? Let's see. From Ignacio, like we would say Nacho in Spain, and actually, yeah. So he has a very good question. So the question is, if the diversification that happens when you're investing in different companies at an early stage to try to identify those winners or to get those winners in your portfolio, if that diversification could happen between different industries, right? Different verticals. So I think that that's a very good question. That would go more in the financial advice type of vertical, which I'm not sure I can respond. But if it was me, for example, the one that I would be investing is like I was saying before, right? So I would create myself like an investment thesis where I'm able to understand which businesses I'm really able to understand, to provide a know-how and expertise, where I have some good background that is going to help me to understand, you know, like how that startup is going to perform or has been performing. Different industries, I mean, if you have a background or expertise on different industries, why not, right? But for the most part, what I've seen or what I would do is to stick to one certain thing that excites you, like what I was saying on the sharing economy, where you would be investing into different companies that are actually within that vertical, but they are also tackling different industries, right? Because if you think about it, you have let's say in the sharing economy, you would have a Uber, which is sharing cars. If you were investing in Airbnb, that would be in the accommodations and so forth. No? So it can be the same type of investment thesis, but it could actually be in different verticals or different industries. So let's see. So I guess that's for the most part the questions. I've actually been told by my colleagues that it's about time to wrap this thing up. I'm actually silent because I wish we could extend this time, but I'm sure that you all have plenty of responsibilities and many more things to do this evening. Anyways, we've received all your questions. We will actually try to respond each and one of them. Again, I would like to thank you all for being part of this webinar. Without all of you, we would not be here where we're at. Without all of you, our startup would not be able to thrive and to really get that capital to keep things moving and to make a difference in people's lives. So again, thank you for being part of this webinar today. Thank you very much for being part of our community, and hope to see you next time. Take care.